times, but an extraordinary belief that we can overcome these times and together reshape our future. When you step back, you'll see it's time for a different kind of expertise, one that helps sustain businesses, that can revitalize our economy. Because sometimes you need to step back to step into a more sustainable world. Partner with the bank that puts sustainability at its heart.
Wow, inspirational. Afternoon all. So the mute button has been pressed. So that's mission one accomplished. Thanks very much for joining us in what is our first edition of our Fireside Chats for 2021. It still amazes me that we're saying 2021 and a whole year has passed and we're sort of in the same situation, certainly from an interaction with clients and the rest of Nedbank. For those of you that have been following us for a while, we started these chats back in July, probably last year, and we kicked it off with Reezwana. We painted a pretty bleak picture for the property sector, and this was on the back of our relatively bearish macroeconomic forecast. His call did prove to be the correct one. As most of you know, South Africa's growth trajectory slowly deteriorated, and COVID probably became a much greater foe than any of us initially envisaged. Then you might recall in our next chat that followed, Walter de Wet detailed the team's thinking behind our bearish SA outlook. And he was one of the first economists on the street to actually pencil in a double-digit GDP decline for 2020 growth. Obviously, a lot has changed since those initial stabs at forecast. On the one hand, you've had the resurgence of COVID infections and very little clarity on vaccine rollout plans. On the other hand, just looking at some of the companies that have reported recently, you've had slightly better results. And some of the macro data that's coming out points to a consumer that probably has been slightly more resilient than we would have anticipated given the lockdown restrictions coming back in. So I think really a lot of parts that South Africa could probably follow from here. And it's for this reason that we have Reezwana Sumad, who is Nedbank's resident macro and fixed income guru that's joining us. I'm a little bit biased here, but I think Reez is probably one of the most talented economists in the market, and she has recently expanded her coverage to include fixed income strategy. I assure you that despite her rather youthful appearance, she's actually one of the longest serving analysts on our team, having started her career with Nedbank almost a decade ago. It's still a couple of decades behind Niels, but still a good stint. She's highly rated on her own, and she's recently won the Young Analyst of the Year award for her work on the macro. Just a bit of admin before we kick on. Note that we are public side, so all of these are independent public views that we're expressing. So there's no material non-public information that we'll be chatting about. I'm hoping and I'm sure that there'll be a few questions as we go along. So please feel free to pop these into the chat. Should be a button somewhere on your screen where you can put those questions in. We will have time at the end to get through as many as possible. Also note that there will be a recording of the event. So if any of you are looking for something to do this evening while you're having your supper, you can switch that on and have a look at Reez and I. We have a few themes that we want to touch on. We'll take probably 25 minutes to go through some of these themes, and then I'm going to leave it up to the audience questions. So Reez, thanks very much for agreeing to join us today and sharing your expertise with us. I mean, first things first, 2021, what's the start been like for you?
Hi, Avi, and good afternoon to all of our listeners and clients that are on. Thank you for that very colorful introduction. I wouldn't call myself a guru, but whatever I've learned in the last couple of years, I'd certainly like to share it and move the conversation forward. 2021, it feels like a repeat of 2020, with the main difference that we have gained some lockdown and COVID-related experience, and we can plan better after having been in this lockdown for much of the past 10 months. But having said that, one has to be more upbeat for 2021, having had the benefit of hindsight, I would think. The discovery of a vaccine and the rollout of this globally has to be up there as one of the key upsides for the year if we had to get it right in South Africa. Unfortunately, COVID has hit closer to home for many of us, many of our clients, many of our colleagues. And so now more than ever, we find people that have the dual benefit of having a job as well as good health. Are some of the things that most people are most appreciative of currently. Whereas if you look at how we started 2020, this were not up there some of the most important things in our lives. So it does feel better than it did, going through a bulk of that lockdown in 2020. But like I said, we've got experience now and we can perhaps plan better.
Yeah. Reez, you've touched on a number of pertinent points there, I think. So maybe let's just kick off with the elephant in the room and probably a question that's unanswerable at this point. COVID and the vaccine, how does that factor into your thinking for the year?
So in terms of the vaccine rollout, from whatever the government's been telling us, from what we read in the media, it seems as though a lot will depend on logistical factors. So in terms of our understanding is that the government would go out and procure vaccines that have been approved already. And the government would pay for this from the fiscus. And then we got private sector being medical aids, private pharmacies, etc., procuring that from the government. And the government rolling out physical, vaccinations across clinics and hospitals. However, there's been a lot bandied about in terms of the cost of the vaccine and how we're going to fund it. And I don't think that money is the most important or most debilitating factor here. I think the actual process of approving vaccines and then negotiating with suppliers to actually procure supplies and then having it imported into the country, and then the labor-intensive task of actually rolling that out to about 40 million people in the country. I think that's going to be more taxing than actually finding or looking for the money, because currently, if you look at the estimates, whatever estimate you choose to use, the vaccine is going to cost us about between 20 and 30 billion rands. But if you look at the fiscus or the size of the fiscus, that's merely a rounding error when you talk about 20 to 30 billion. I think the physical and the logistical aspect is going to be much more difficult for a small economy like South Africa.
Yeah, We'll definitely touch on that funding issue. I think there's probably bigger issues than the 20 to 30 billion in terms of the budget that's coming up. But let's just set the scene, Reez. Let's go back maybe 6 months where you guys were from a GDP forecast perspective. What was the thinking? What's changed? And where are we now in terms of our expectations for firstly 2020 growth and then what's going to happen in 2021?
Okay, so we have been relatively more dovish relative to consensus on growth for quite a while now, since the start of 2020. And 6 months ago, we were expecting a contraction in 2020 of around 9% in terms of real GDP. We moved that closer to 8.5% currently, and that's still relatively bearish or dovish compared to consensus and some of the other estimates that are out there. For 2021, we're seeing a growth forecast of 2.5%, and then 2022 around 2.1% growth. Now, the reasons why we've been on the lower end of the spectrum for growth has to do with two things. It's basically consumer spending, or the lack of consumer spending, and the lack of gross fixed capital formation, so private sector investment essentially. So we're still seeing consumer spending or household consumption spending declining in 2021, less so than it did in 2020. But if you look at gross fixed capital formation, I think that's where the biggest concern is, being that double-digit or 11% contraction that we're forecasting in terms of private sector investment for this year. Now, if you look at the pandemic and how that's evolved, it's resulted in consumers really increasing their savings. So household savings rates have gone up to multi-year highs from when I looked at the data back to 2005. In fact, we currently have one of the highest saving rates relative to our history. So surely once the pandemic ends or once life returns back to some form of normality, we're expecting consumers to start to spend some of this pent-up savings. But what's a bit unclear currently is that if you look at previous crises and previous pandemics and financial crises, it had materially changed consumer behavior permanently and spending patterns permanently. And so the current pandemic, it's a bit difficult to sort of forecast how this pandemic is going to impact permanent consumer spending patterns and behavior. And for one aspect that we see that's a little bit more negative than what sort of the market is impacting is spending on services. That's permanently lost spending. For example, if you emerge from this lockdown, consumers are not going to start taking 2 holidays, buying 2 car washes, or 2 haircuts. So it's permanently lost spending on services that we now have to try and pull back into the economy in terms of spending elsewhere. And so we think that the pandemic will leave a big hole, particularly for 2020 and 2021 spending in the economy as well as investment in the economy.
So Reez, let's assume you guys are right on the 2020 number and we go back 8.5, and then I think you said 2.5 growth for this year. Maybe if we have to flex that, so upper end and lower end, what do you think the higher end could be, and what do you think the lower end of growth could be in 2021?
So there's a lot of uncertainty. I mean, we could have multiple waves of this pandemic. We don't even know whether the vaccine is going to be effective, and we don't know whether we're going to, have further lockdown. So given all of those uncertainties, in my opinion, I think the high would be what consensus and the SARB's forecasting currently, 3.6%. So we really do think that the bias or the risk to growth is firmly to the downside relative to that forecast. But if you have to ask me for an upper end for this year, would be around 3.6%, which is what the SARB and consensus is forecasting in terms of real GDP growth. And the bottom end, I mean, unfortunately, we cannot rule out another negative year of growth. So I'd like not to place a number on that, but we need to actually be aware and open to some of the downside, a lot of the downside risks that the current pandemic will sort of bring about. If a vaccine rollout is not managed, or if we don't get confidence back up and spending back up and private sector spending, up in the second half of this year, we cannot rule out another negative year of growth. So I think that's where sort of my scope is in terms of expectations for the year.
Yeah, I always love the honest, straight answers, Reez. So, I mean, last week we were probably all a little bit surprised by the relatively hawkish tone from the SARB. What are they seeing in terms of growth that makes them a little bit more optimistic than they previously were?
So in terms of what the SARB had indicated last week, they slight upward adjustment to the growth forecast for 2021 is as a result of base effects. So the third quarter of last year, we had a 66% quarter-on-quarter increase in real GDP growth. And that was well above what they were initially forecasting. And because of that upside surprise, they had to readjust their contraction for 2020 and then the growth forecast for 2021. So it's nothing sort of fundamental, no real fundamental changes to some of the subcomponents, but merely just sort of a base effect adjustment better. But I think some of the aspects that according to us represent risk to the downside would be, load shedding that started in January, and that's going to have a negative impact on output, surely, especially in the secondary sector. And if you look at already high frequency economic data prints for the fourth quarter of last year, like retail sales, mining, manufacturing, production, credit growth, all of those have disappointed. So we sort of starting the year 2021 on a very muted footing. And I think for the SARB, there haven't been really fundamental positive changes to their forecast. It's merely just been base effect adjustment, and the fact that they're slightly more optimistic on some of the balance of risks that that we're seeing or other analysts are seeing in the market.
Thanks very much, Reez. Maybe, we've got a few topics to get through, so maybe just to leave it on growth, which sectors do you think will perform better and which sectors will perform worse, assuming your base case plays out?
So it's still assuming a very, very muted recovery and a sort of weak economy, and thinking about which sectors sort of outperforms in this type of macroeconomic environment. I would think defensive sectors, your food retailers, pharmaceuticals, given the COVID pandemic, healthcare, some of the obvious choices in this type of weak economic environment. But then, going forward or looking forward, tech-based sectors or industries have definitely, benefited from the pandemic and likely to build on that in the next couple of years. And I think, what's also very difficult to get data on is very, very micro enterprises. We've seen a lot of home-based industries take off, on a micro scale. So those are some of the places where I think growth or this pandemic will benefit those industries. On a long-term basis, and given the changes in behavior and changes in working styles that's afforded to us in the current pandemic, one would have to think that IT-based sectors and tech-based businesses will take off, on a more medium to longer term basis. So that's how I see it. Your necessities being, the most preferred during a weak or in a weak economy, and then after that, if you look at some of the growth stories after the pandemic, would be tech, micro home-based industries, and IT-based industries and delivery services. I'm sure you must have bought a lot of stuff online now in the pandemic compared to ever at any point in your life. So yeah, those are some of the obvious choices for me.
Yeah, I think we can all attest to buying a few more things online than we did previously. Reez, moving on to everyone's favorite topic now, the Rand. You guys have been very, very good on calling the Rand, pretty bullish despite a very weak economic outlook through the most part of last year, and that worked out pretty well. I know you guys have recently upgraded or downgraded the Rand and taken a slightly less bullish stance. Maybe just to kick off, how do you think about the Rand?
So in terms of the Rand, the economist in me would like to think that it's more demand and supply dynamics that affects the Rand, or more sort of fundamental purchasing power parity fundamentals that influence the Rand. But on a short-term view, it's global financial market conditions and sentiment that drives the Rand, and that's what we saw last year. We saw that sharp sell-off in March and April in terms of the dollar Rand, weakening to over 19 Rand. But after that, you see that sharp pullback in the Rand, because we've seen this. It's played out before in other crises. And as a result of that, from that extreme peak, we see the Rand recovering as it had done, in prior pandemics and crises. Going forward, how we view the Rand, and yes, we did, downgrade our forecast on the Rand, expecting a gradual weakness, particularly in the second half of this year. The main reasons for that has to do with firstly, our real forward-looking real interest rate or real yield. If you look at that, our real policy rate on a forward-looking basis is negative, and we think that that will likely drive the rand, slightly weaker towards the year end. But if you look at inflation, that's also ticking up, and that's likely to eat into real yields. But if you look at going forward and our competitiveness relative to our peers, our fiscal trajectory is far more worse now compared to when we started or entered the pandemic. And from a relative competitiveness basis, our debt trajectory is amongst the most unsustainable and worse amongst our key peers. Our twin deficit or twin balance remains widely, quite wide, well above 15% of GDP. And, some of the fundamental drivers in the economy dictate, a weaker rand trajectory going forward. So I think that that some of the reasons that substantiated us moving to a less upbeat view on the rand, but also the fact that the rand returned back to our 1.5 standard deviation level from our extreme peaks model. So it returned to that 15 rand against the dollar mark. And so from that aspect, we had to sort of revise going forward in terms of what we're expecting. So for this year, we're expecting a rand to end the year closer to the 1650 mark compared to last year, where we'd expected it to end the year closer to the 15 rand against the dollar mark. But if you look at our range that we have, that we will likely remain neutral, we have a range forecast between 15 and 16 for this year. So with the rand weaker or above 16, that presents sort of a buying opportunity for the rand based on our fundamentals, and vice versa for a rand below 15.
Thanks very much, Reez. And maybe, I mean, you touched on it a little bit, but we've got the budget coming up in a few weeks, and that's obviously going to be quite important for some of the factors that you spoke about. Maybe just highlight your expectations going in and some of the key things we should be looking out for.
So there's a lot of recent attention has been given on raising taxes. So sort of wealth tax to get more revenues coming in. We firmly have the view that South Africa cannot afford any further tax increases. We have one of the highest tax burdens in the world. In terms of the Laffer curve, the curve that dictates tax rates versus how much we can actually collect, we are firmly past the peak of the Laffer curve, implying that higher tax rates will in effect result in lower tax revenue collected. If you look at employment conditions locally, we've lost a lot of jobs with unemployment close to 31%. And given the number of fatalities, very, very skilled people dying, and the loss of income from that, we don't think that the consumer and the economy can afford higher taxes currently. But over and above that, if you look at the government's cash position, the government's cash balances are quite high currently. So like I said initially, the debate of firstly who's going to pay for vaccines and whether we can afford 20 or 30 billion rand vaccine rollout, that seems to be like a rounding error compared to some of the bailouts that we've provided to SOEs, or in terms of the revenue forecast, we've disappointed. If you look at this year's revenue collection compared to last year, will likely be about 243 billion rands lower. So we're talking about much bigger numbers on a nominal rand basis in terms of revenue disappointments compared to pre-pandemic, relative to some of the expenses that we that we're talking about currently, and the fact that media is going on about raising taxes, or the potential of raising taxes to pay for a 20 billion rand vaccine rollout, is something that I'm just failing to understand given the other numbers that we're talking about. So in terms of the budget, what we're hoping to see is a massive reduction in terms of expenditures. So cutting wasteful expending. The government has recently implemented this zero-cost budgeting, where municipalities and provinces would only sort of receive funds once they make a case for it. And so I think that's a much more prudent way to sort of trim the fat and reduce expenditures. But it has been a battle that the government has trying to win for a long time now. And if you look at the wage bill, and that's a much more recent issue, whereby last year National Treasury tried to cut the wage bill by about 160 billion over a 3-year framework. 3-year medium-term expenditure framework, and that battle is still continuing in the courts. So, from if the budget were to sort of inspire confidence, I think we need to focus on an infrastructure rollout program that's there, but we haven't really seen any progress on that. We need to focus on actually not, constantly bailing out SOEs. There must be, better decision making from a leadership perspective when it comes to managing SOEs. And I think any sort of mention of wealth taxes or higher personal income taxes that won't go down well, for the consumer and even for the fiscus itself. Eventually, when we end the year off and we see that we haven't reaped those sort of rewards. There also been talk of social grants or an additional social grant being given, and that's positive on a short-term basis because it increases VAT. So that essentially gets spent in the economy. It increases VAT, but South Africa has much more bigger permanent structural problems to address, and we can't sort of tax ourselves or grant ourselves out of the problem. We need to grow ourselves out of the problem. And so we need to figure out how we're going to increase GDP growth. One way of doing that is by spurring confidence and creating an environment that businesses will be willing to invest and spend in the economy, employ, and then grow. But ultimately, it comes down to strong leadership and decisions taken by the leadership. On the political or on the public side, as well as on the private side, that will sort of get us better growth. We're sort of stuck in a low growth trap currently because no one wants to take tough decisions. That's how I feel.
And talking about tough decisions, Aries, you mentioned the public sector wage bill. What is the potential for significant cuts to come through, and how does it happen? Is it just zero inflation for the next few years, and how much will that save us?
So when we looked at it, just merely reducing the increase or the inflation rate in the wage bill doesn't really give you much. When a 1% saving in terms of the wage bill yields about 55 billion rands. Now, when we have a deficit that's in excess of 700 billion, here again, a 55 billion rand saving over a 3-year period, that is, doesn't give us much. So in the absence of headcount cuts and actually trimming down the number of unproductive employees in the public sector, in the absence of that, there's very little that can be done from a wage bill, in my opinion. If you look at the wage bill and how that's constructed, there are various cost of living adjustments that are already provided by the government. And the on top of that, the wage increase on top of that, just adds to the cost. So you get housing subsidies, you get medical aid subsidies. There's various other like I said, cost of living adjustments that add to the cost of the wage bill, and it's not just, the year-on-year increase. So it's a bit of a difficult situation, because on the one hand, the government wants to safeguard employment, create more employment, in fact, and grow the economy in that way. But on the other hand, we just cannot afford a wage bill that consumes 1/3 of total expenditures, or makes up 1/3 total expenditures. So for now, I think that we're unlikely to achieve the 160 billion rand savings that the government set out for. But I think any incremental gains in the wage bill itself will be positive. Like I said earlier on, cutting the fat in other areas of wasteful spending and clamping down on corruption and bad procurement practices, those also need to be implemented with changes to the wage bill.
Yes, we've probably got one more topic to cover, and we're fast running out of time, so we'll get to questions in a few. Just a reminder to the audience to please put through any questions that you might have that you want to ask Reez. If we can't get through it now, we'll definitely reply to it a bit later. So Reez, I mean, the final topic is just around inflation and rates. As we mentioned, a hawkish hold last week. What are your expectations on both fronts for the rest of the year?
So we're expecting inflation to rise gradually this year and next. The main reason for the higher inflation forecast of 3.9% this year and about 4.4% for next year is as a result of higher electricity prices, or electricity inflation, transport inflation, and food price inflation that have already risen. And so those are some of the key reasons that's causing us to see slightly higher inflation. In terms of rates now, naturally, should inflation increase and your real policy rate dips into negative territory, naturally one would expect higher interest rates or more hawkish SARB like we saw last week. But on the one hand, we have a very, very weak growth and the possibility of growth disappointing to the downside. And we risk, the key risk that we have here in South Africa, in the South African context, is hiking prematurely and undoing some of the relief that we've provided, the SARB has provided to consumers in the past 10 months of the pandemic. So we do believe that there's still downside risk to growth, certainly relative to the SARB forecast. And on the back of that, we think that the hiking cycle that the QPM currently projects to begin in the next quarter, we think that gets postponed out into 2022. And I think the SARB is also very aware that premature hiking can stifle a lot of gains made in the past 10 months. So it's a very sort of difficult call. I think that we'll have to sort of wait and watch how inflation unfolds in the next few months. If inflation does, increase much more rapidly than we and the SARB forecast and consensus forecast, then yes, the hawkish stance is warranted given the SARB's core mandate of price stability and that 4.5% inflation target. But if inflation is much more muted than we're expecting and the SARB's expecting, then that provides them with some room to sort of hold off on hikes. So that's how we're looking at it for now. Given that we're still in a pandemic, a lot can change. These forecasts are very fluid, and unfortunately, I wish I had a crystal ball to be more sort of accurate in terms of our forecast, but all we can do now is just look at the high frequency economic data prints, and if it changes materially relative to what we're forecasting or some of the subcomponents in our growth and inflation forecast, then we'll have to be much more reactive with that. Maybe
just a final point on rates, Reez. the cuts that have come through, I mean, they've been significant over the past year. I think 300 basis points in 2020. Is there an element of consumer confidence being so low that those cuts didn't come through just yet, and there might be a bit of catch up coming through, or do you think that rates low doesn't really impact consumer spending for this year?
Yeah, so if you look at this, the SARB's research and, global research that's out there, it takes about 12 to 18 months. Any sort of monetary policy action takes about 12 to 18 months to filter into the real economy. And so we're likely to see that consumer spending on the back of those relief measures start to come through now, if it hadn't come through already. So we already saw a bit of a spike in terms of pent-up demand in the third quarter of last year, potentially in the fourth quarter as well. So those benefits are likely to continue, occurring in the economy into 2021 as well. But also what we must not forget is that these cuts that have come through in the midst of a pandemic. So previously in sort of business as usual economy, consumers might go out and blow those savings, but during a pandemic where every other person that you're looking at is losing their job or having their incomes halved, or actually having lost loved ones, or not having the finances to pay for medical costs. In a pandemic like this, it materially changes not just confidence but consumer behavior. And that's something that I think is still uncertain, and there's still a sort of lack of data as to how that will sort of play out. But I do think, and from what we've seen, consumers have become a bit more cautious. In fact, quite cautious during the current pandemic. And I think that where we have seen a bit of an uptick in consumer demand, that it's not sort of the benefit has to spending or to the consumer has not been incurred 100%. So part of those savings have gone to spending, but a big part of it has gone to buffer up savings as well. That's what the data showed us.
Yep. Thanks very much, Reez. I'm going to go straight into questions. We've got a few from the audience, so I'll just read the first one out. And this one sort of talks about vaccine and then talks about issuance as well, which I think is a pertinent topic. So would it not be cleaner and easier for government to fund the cost of the vaccine from capital markets? According to the MTBPS, the intention is to reduce funding through reduced weekly issuance. Would it not make sense to delay the reduction and fund the vaccine through maintaining weekly issuance at current levels until you've raised enough capital to fund the vaccine?
So I've been looking at the numbers quite closely. If you look at the 2020-2021, the current fiscal year, according to our calculations, National Treasury would have overissued or pre-funded by about 97 billion rands. This means that they would have raised 97 billion rands more in issuance than it actually needs to pay for the budget deficit, to fund the budget deficit. It implies essentially extra money that it has relative to the current forecast, or the MTBPS forecast. And so if you think of what the cost of a vaccine rollout would be, 20 to 30 billion, that can be easily funded by the current extra issuance that it has or is forecasted to have for the current year. But over and above that, if you look at the issuance profile and the cash balances, excess cash balances that the government has, I think if I have to look at the number that I have here, as of December, our total cash balance that we have, or National Treasury has, is about 378 billion rands, and that's massive. It's the highest, I think, ever recorded. National Treasury had about 234 billion rands of cash banked with South African banks, and so it's massive cash balances that can I think can easily pay for the vaccine. So like I said up front, I don't think the issue is with lack of funds or lack of money or where we get the money from or how we budget for this. I think the bigger problem or the bigger question here is the logistical issue. When the do we have we even secured supplies, and when can we get it? How fast can we get it into our country?
Yeah. Thanks, Reez. Slightly different tack, but very important question. What are the expectation of the sovereign's credit rating for this year? Constant, downgraded, or does outlook get revised?
Yeah, so I think that if you look at the budget, that will be the key determining event for S&P and Moody's, and I wouldn't ignore the possibility of a one-notch downgrade by both of them. However, having said that, we're already below investment grade on S&P, Moody's, and Fitch, and so the bigger question here is how fast does our CDS and credit risk react, and how much more steeper does our curve go on the back of a deteriorating fiscus and a potential downgrade. So I think that given the fluidity and uncertainty as to the fiscus and the budget, we need to look at the budget first and whether they do achieve the expenditure reductions that they've promised or at least even forecast over a 3-year period. And if that is the case, how quickly can we reduce our debt burden? If you look at our forecast, we're seeing the debt to GDP ratio hit 100% by 2024, 2025. If you listen to what the Director General indicated a few weeks ago, that ratio could be hit much sooner than that. So it all depends on as to how they manage, National Treasury manages the debt trajectory, whether it does come down, and I think that will influence our credit rating.
Thank you, Reez. I'm taking a lot of questions that are on a similar tack here, and just to paraphrase, I think generally government has good policies out there. The execution has definitely been an issue. So do you think that, is there anything that has changed that would encourage you to think that execution will be a little bit better over the next few years?
You know what they say about everything, sort of when an economy is as weak as it is currently, there can only be upside, and they say also the opposite, whatever goes up must come down. So in terms of how I'm seeing it, the economy has weakened significantly. We've lost a significant amount of jobs, not just in the past year, but in the past 5 years because of a lack of implementation in some of the programs that were promised, particularly the infrastructure investment. I certainly think that going forward over the next 5 years, private sector needs to sort of take over the baton from government, and maybe perhaps even hold the government's hand in terms of directing and managing some of the infrastructure-led growth that had been promised way back in 2018 or 2012, if you have to go back and look at the government's history. So I do think that the economy is so weak currently that there can only be sort of upside from here. I guess what's quite concerning is the fact that there hasn't really been much decision making or any sort of urgency or action with actually procuring vaccines, and we're still debating how we're going to pay for it. I think that's very concerning. We need decisions to be made, and you know what they say about decision making. You take the decision now, and then only later you realize whether it has been a good decision or bad decision. But you take the decision now, and I think that's what's holding up not just a vaccine program, but a lot of the structural reform that is there in black and white. For example, the spectrum auction. That's been going on for the past 2 to 3 years, and why has that not been implemented? So I really do think that a lot of the upside will likely come through from the private sector, or needs to come through from the private sector, because there's been a lot of red tape, bureaucracy, and lack of decision making in the public sector to sort of drive this growth agenda in the past.
Reez, I think that's us out of time. As always, fantastic catching up with you and hearing your thoughts and giving us as much information as we possibly can in this very difficult environment. I think just to recap, we're a little bit more bearish on the rand than we were. Inflation going to pick up, a little bit more bearish on growth. Yeah, so let's see how we end the year. Thanks everyone for joining us. We've got a number of questions here that we'll endeavor to get back to you guys on. Enjoy the rest of the day, and thanks for joining us again. Cheers.
Thanks, Avi. Bye.